Let's begin with US, whereas the US economy nears full employment and central bank copes with the surge of inflation. The central bank Fed Reserve, it would end its pandemic-era bond purchases program. Well, the end of purchases in March will pave the way for 3/4 percentage point interest rate hikes by end of next year. The pace of inflation is uncomfortably high, and in their new economic projections, policymakers forecast that inflation would run at 2.6% next year. It's an increase of 2.2% they projected in September, but it will fall to 2.3% in 23 and 2.1% in 24.
The Federal Open Market Committee kept interest rates near zero and updated its assessment of the progress that the economy has made toward the criteria specified in the committee's forward guidance for interest rates. In addition, in light of the strengthening labor market and elevated inflation pressures, we decided to speed up the reductions in our asset purchases. We are committed to our price stability goal. We will use our tools both to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched. We will be watching carefully to see whether the economy is evolving in line with expectations. The rise in COVID cases in recent weeks, along with the emergence of the Omicron variant, pose risks to the outlook.
In US, the unemployment is seen dropping to 3.5% next year. It is well below the point Fed officials feel is sustainable in the long run and remaining there through 2024. WION correspondent Susan Tehrani has sent us this report from New York.
While the Federal Reserve provided multiple indications on Wednesday that it was willing to make some aggressive moves to tackle the rising inflation here in the United States, for example, accelerating the reduction of its monthly bond purchases, and then after that, a set of interest rate hikes starting in 2022. It's yet to be seen whether or not these measures may be too little too late. Some economists and perhaps consumers wanted to see an even more hawkish approach coming from the Fed. For example, an immediate end to money creation and also immediate interest rate hikes. Now, these measures by the Fed come at a time when the United States is witnessing an inflation it has not seen in almost 40 years. And for a while, Fed officials had maintained that the inflation is transitory. However, White House officials recently said that may not be the case. Susan Tehrani reporting from New York for WION World is One.
WION now available in your country. Download the app and get all the news on the move.